I'm going to share my screen here, and hopefully you'll all be able to see that as well. And I'll take you through the presentation that is currently on the website for the South 32 royalty portfolio acquisition. And we'll try and run through this in the next 15 or 20 minutes, and then open up to some questions. And as we go through the presentation, if you want to ask any questions and put them in the Q&A section, we can come to that at the end and go through them that way. So thank you very much, and I will start now. So welcome everyone to the South 32 royalty portfolio acquisition webinar. The first slide here is forward-looking statements that this presentation contains, and here we have a summary on the acquisition. And I'll give everyone 2-minute background into Elemental first to set the scene. And we are we've been around since early 2017 as a royalty company, but we are today about 4 months old as a listed royalty company, having started trading on the TSXV in Canada at the end of July 2020. And I think that in the time we were private, we built a really high quality portfolio of precious metals focused royalties over advanced and producing assets. And that gave us the foundation and the critical mass to list a company and really to hit the ground running and to do an acquisition like this in our first deal as a public company. And I think it's really important just to note a few things is before we begin are that prior to this transaction, we were about 90% precious metals weighted. We were similarly very weighted towards producing assets, so advanced, and we had quite a concentrated portfolio of 6 royalties, but we had guided when we listed that we were looking to do either really material transactions that moved the needle for the company and put us in a different place, and alongside that continue to do the opportunistic individual acquisitions as and when we saw them. And I think that this deal clearly fits into the category of the transformative acquisition. And it's 3 royalties all in Western Australia, all gold assets. And we announced last Monday that Elemental was acquiring it in a transaction for $40 million in cash and $15 million in equity, with South 32 becoming a major shareholder. And it's our first acquisition as a listed company, and I think that it's great to get off the ground with such a good meaningful acquisition that puts the company in a different place. And the largest royalty of the 3 is on Capricorn's Karlawinda mine. So it's Australia's newest gold mine, starting commissioning in Q2 of next year and targeting annual production of about 115,000 ounces a year. And I think we all believe that it's got really good upside, both in the medium term and in the longer term, for production increases and for resource expansion, which is exactly what you want to see in a royalty. I think that one of the points that flows through from that is that this is going to have a material impact from us going forwards, especially from mid next year onwards as the mine comes in. This is going to have a really meaningful impact on our revenue. And we'll come to that later in the presentation, but you can see it's forecast to grow our revenue both in 2021, in 2022, and in 2023. So we get an awful lot of growth through this acquisition over the next 3 years. Importantly, it weights our portfolio towards Western Australia and towards a tier 1 jurisdiction. And I think people always want to see that in a royalty company, and this is what this transaction delivers for us. And of course, South 32 becoming our largest shareholder, I think is a very good validation of what Elemental have set out to do from the outset, which has been to assemble a portfolio of high quality royalties. And we're not looking to do 40 exploration royalties. We're looking to do good quality royalties that will put us in a different place, move us significantly going forwards. And we had we're closing the financing. It will be at the moment, but it's very pleased with the support we've had both from existing private shareholders and institutional shareholders to do this acquisition. On slide 4 here, I've just gone through onto the next slide for those who aren't following it, but you can see an outline of the 3 royalties. It's a 2% net smelter return royalty on Karlawinda, a 2% gross revenue royalty on Focus's Laverton project, and a mixed Australian dollar royalty on Rumble Resources Western Queen. And I think the largest royalty by size here is Karlawinda, which, as I said, comes in mid next year, and then Laverton, which is development project and forecast for 2022 to start producing, and so that then adds to our revenue from 2022 and 2023 onwards. And if you, I think this slide is really good just at a high level to summarize the impact it has. And you can see that in terms of our royalty portfolio at the moment, our net asset value, we're immediately more diversified following this transaction. You can see Wang Yon as our biggest royalty now at 58%, becomes about 20% after this transaction. And you can also see in terms of the contribution by country, we go from being the majority exposed to Burkina Faso at the moment to the majority being in Australia. And I think, again, that's a really good position for us to start from, and it diversifies the portfolio even further. So I think all of that is really important as we continue to grow the company. And if you come on to the next slide, on slide 6, here again, you can see in terms of revenue, the impact it has from 2022 onwards, when we have a full year of Karlawinda revenue and Laverton starting to come in. You can see then that, again, the diversification in the portfolio, it continues to grow as we build it out. And even looking at the mine life, I think both Karlawinda and Laverton expected to extend our mine life on an average level across the portfolio. So not only are we almost doubling the size of the company in terms of revenue, in terms of size, we're extending the mine life. And I think that's really important, because one of the things we don't talk about in this presentation, we don't touch on, but is always there in the background, is organic growth. And that is growth through our existing royalties, existing operators, continuing to add ounces and continuing to make discoveries on their licenses and on their projects. And as we grow the portfolio, key aspect is that we get more optionality across it, and we get more exposure to projects that will be able to, we hope, add many years to their mine life going forwards. And all of that comes at no cost to Elemental shareholders. In terms of the capital structure, you can see here that the pro forma after the issue of shares to South32 and the private placement will have a market cap of about $89 million US, and with a net debt position of about $18.5 million US, we'll have a pro forma enterprise value of about 107 million. And you can see the breakdown on the right there. It's still with management and directors having a very significant stake, and the majority of directors are participating in this fundraise, as well as some of the management, and institutions as well will be part of that new equity. So I think we'll still have a very good breakdown of the shareholding structure after this transaction. And here, I think this goes a long way to showing how transformative it is. And you can see immediately that on every metric, number of the royalties we have in terms of the market cap, enterprise value, net asset value, revenue from, we talk about 2022 onwards, when we start to see a full year from Karlawinda for our benefit, you can really see how much it puts the company in a different position. And I think that from our side, we have done a very good job as Elemental, as a private company, in acquiring really good value royalties to date. Royalties that, like Kwale, repaid us in 2.5 years, Amankaya, where we're sort of 80% repaid on. And I think an acquisition like this helps give us that blend of critical mass size, as well as some of those really good value royalties we have been able to build the company up from. And if you come on to slide 9 here, I think this slide is one of the ones that we always think, when we look back on this 3 years ago, it looked very, very different in 2017 to where it did in 2018, to where it did in 2019, to where it does today. And I think our hope is that every time we have an acquisition, we will be able to look at this slide again, and we will be able to demonstrate more growth coming in. And so you can see that with half a year, roughly, revenue from Carla Winder, we're getting up towards 8 million a year revenue next year, and then up towards 12 million a year with Laverton coming on stream in 2022. And then in 2023, we have a full year forecast from Laverton, as well as a full year from our existing Mercedes royalty that starts paying us in 2022. So already, if we do nothing else, you will see the growth we have in here over the next 3 years. And I think that the key phrase there is if we do nothing else, because we gave this presentation when we listed the company, and we said, if we do nothing else, this is a revenue we will have. And I think after our first acquisition and being 4 months old, just about, as a listed company, you can see already what a different position we are in going forwards. And I think that's important because one of the business model benefits in the royalty space is that your fixed costs are relatively stable. And so you can see here that if our revenue is going up by 178%, our adjusted EBITDA would be going up by 447%. And that is because for every $1 million of revenue we are adding, 90% order of magnitude is going straight through to free cash flow. And so as we scale the business up, we get all those benefits coming through to us. And that's why, as a royalty company, particularly a fast-growing royalty company of the size and scale we are, I think we can get an awful lot of leverage from some of these acquisitions because of the nature of the business model, and because we are not incurring any costs to run these operations going forward. And here, I think, touching on this earlier, but for everyone's benefit, just to take you back to the history of the company, when we started in 2017, and we did our first royalty, it was $2 million, roughly speaking, and we actually had to syndicate it 50-50 with a private equity fund and give half of it away to get the deal done. And I think if you take it through to where we are today, coming out of this with a plus $100 million enterprise value, and having just done a $55 million royalty acquisition, I think it really shows you what a different position we are in today to where we were before. And it's often sometimes things you can't see, intangibles, but the team when we started, I say that at the beginning of this year, we had 2 full-time employees. Well, as of last week, when someone joined us here, we now have 4 full-time employees. So it's still a very small team, but our ability, our bandwidth, our experience, our ability to do more transactions, our experience in finding new royalty opportunities and looking at existing ones, all of that stands us in a much better stead today than it has ever been in the past. And I think we have done that while increasing the share price at every fundraise we have done to date. And this is an overview here of the royalty portfolio and what it will look like on closing of this acquisition. And you can see straight away, I think the thing that stands out is we now have 5 royalties in Australia, all in fact in Western Australia. And I think that gives us a lot more leeway going forwards to look at royalties across different jurisdictions, having that really solid foundation in Australia. And that is that's a summary of the presentation. I think on this, we have some slides following it on the individual assets, but I think I'll leave people to go through that themselves. And if you have any questions on that, feel free to ask. But what we can do now is we can come to some of the questions and address some of those. And so if anyone else has any, please feel free to put them in the Q&A, and we'll try and answer those. And so the first one we have, thank you very much, is, I'll read it out as well, is hi Fred, the royalties seem to like New York Stock Exchange listings. Is this something Elemental will follow the lead of Metalla, Mavericks, EMX, etc.? If so, I believe it would make you the first Discovery Group company to do that. Well, thank you very much for the question. I think that we announced, maybe it was a month or so ago, that we were starting trading on the OTC in the US. And I think that is the first step for us. We've been listed for 4 months, so we'll get the OTC listing and we'll make it, ensure it's easier for people to trade us via that. And then we will, I think as we grow, we will be able to consider other options like a New York Stock Exchange listing. I think there's probably a time and a place for that, and you might have seen that with some of the companies you referenced in terms of the size they were when they did that. So it's definitely something that we're aware of, and I think that we can sort of cross that bridge when we come to it, but definitely something we've considered. And the second question here is, you probably can't give specifics, but will you be doing any deals within the Discovery Group? Of course, a Great Bear royalty spin-out comes to mind, but could be others. Okay, it's another good question, thank you. And I think that the key point we have to make here, and we always do, is that all the companies within the Discovery Group are independent, and so everyone will, both the operators and us as a royalty company, will have to come to independent views on the valuations and what makes most sense for us to do, in terms of both shareholders. But I think that it's always an advantage knowing the management of the other companies, and I think for them to know you as well. And that's something that we haven't been able to do as much over the last 6 months because of COVID and travel restrictions. But I think that it's something that a royalty company like us always really benefits from, which is networking, which is knowing the management teams of other companies. And I think that the South 32 transaction gives us a lot of credibility in that regard. Having an $8 billion miner as your biggest shareholder, I think, opens the doors to a lot of other potential opportunities with corporates. So one other question here that I'll answer next, thank you, is following the South 32 acquisition, do you see a period of consolidation, or are you moving ahead to try and acquire more? It's a very good question. I think it's one that for a royalty company like us, it will be a permanent state of looking at opportunities. And we said publicly before this transaction that we had 8 to 10 royalties sort of under review at the time. So maybe it is sort of 7 to 9 royalties under review at the time now. But we're always looking for new opportunities. And I think that often the acquisitions that we can execute on and announce, I think those are often, the timelines are driven by the vendors. And so for us, it's always really, really important to have a number of opportunities in the pipeline. And that is, without exaggerating, I think that happened the day after we made this announcement. We immediately started work on a number of different royalty opportunities. And I think that's part of the benefit of the model as well. We don't have to run these assets. So in conjunction with closing this acquisition, and it is a really material one for us, we can start to open up some of the other ones we had been looking at and see where we can get those. Another question here is, do you have a rate of return number on the South 32 royalty package or a payback time frame? My impression is that this package is great for providing diversification and scale, but not necessarily as good value as some of your earlier deals. And I think that's I think that hits the nail on the head in terms of some of our earlier royalty acquisitions were, I think, in every sense, excellent value. And I think that if you look at the Mercedes royalty, we will be repaid on an annual basis the cost of the whole royalty, and it's an uncapped royalty over the life of mine. Quale, I mentioned, was a 2.5-year payback. I think that on Ankyra, we're 80% repaid. On Mount Pleasant, a fraction of the existing resource that is mined there will repay us the acquisition cost. So I think that's I think it is a case of we're trying to blend the opportunistic acquisitions where we see them with the really material ones. And Teranga's Wang Yon was probably a good example of that. It was a royalty that we paid $12.5 million for, and at the time it was a relatively sort of 1x NAV on that. But actually looking back on it now, the increase in production they've had at the mine since we acquired it, the fact that they're now looking to advance exploration to build out the mine life, I think all of those are real positives on the valuation from when we bought it. And so I think it's a similar number here, in that we're looking at about a 1x NAV on this acquisition. And so that gives us a sort of similar, at the time of acquisition, similar return threshold to what Wang Yon was. and that's a sort of 5% return on a 1x NAV valuation. And that's, I think the key is it's assets where all three of these mines used to be former WMC assets in Australia. And Richard and Peter, our technical manager and one of our directors, who both were in Elemental before we listed, both came with 20 and 30 years at WMC. And so I think very helpful for us to be able to tap into some of that experience when we were looking at the assets. And it gave us an ability to get a lot more comfortable with them than I think we would have been able to without that. So next question is, what makes Elemental different from all the competitors, and how do you acquire the best opportunities in the face of competition? Well, I think the first thing that stands out with Elemental is that for a sub-billion-dollar royalty company, we have a very high proportion of advanced and producing royalties. So I think typically, if you looked across the subsector of the royalty market, you would see companies that have 1 or 2 producing royalties, and they might have 10, 20, 30 exploration and development royalties. And I think we turn that on its head. And I think to a large extent, we do the hardest part first, which is we really focus on getting producing assets from the outset, diversified revenue and cash flow from the outset, that then enables us to build out the pipeline. And I think if we can get to a position in a year's time where we have order of magnitude $10 million a year of revenue, and we have a credit facility in place for sort of $25 to $30 million of funding, I think it puts us then in a very good position to be able to continue to build Elemental versus having 1 or 2 producing royalties and a large pipeline of development and exploration royalties that we are diluting ourselves for. So I think that's one of the key differences in terms of Elemental today. And how do we acquire the best opportunities in the face of competition? I think part of it is the fact that we have been private for 3 years before we listed. That gives us a big head start. And so a number of these acquisitions, including to some extent the South 32 one, were opportunities where we had spoken to the owners, we'd spoken to the other parties, in the past. And so it's often not the first time, the second time, the third time. It's often the 5th, the 6th, the 7th time that you actually have an ability to transact on an opportunity. And I think that that is the case for a lot of the ones that we see, privately held royalties, where maybe we have spoken to the owners before, and as we get bigger and as our track record, I think is more established and it's easier to point to it, I think we're in a better and better place to revisit some of those royalty opportunities. So the next question is will your focus continue to be on producing royalties? And I think that that's one of the areas we have definitely focused on. I think it's always a case of balancing competing opportunities against each other. And we've certainly looked at some in the development and exploration stages. I think that the hurdle for those is higher for us because if we can buy a producing royalty, it typically comes with exploration upside, as well as having that immediate revenue and immediate diversification for our revenue and portfolio that it provides. So I think that we definitely like the producing royalties where we can, but I think that it's also we are alive to the opportunities outside that is probably the best way to answer that question. Another question here is that miners are pursuing innovations such as AI, for example, GoldSpot. Do you see any possible innovations in the royalty and streaming business model? And if so, what might Elemental consider doing to lead the innovation charge in this space? It's a really interesting point that you raise. I think that the royalty and streaming models, I suppose over the last 10, 15 years, there's already been a lot of innovation in it. And if you go back to the size of the market in the sort of mid 2000s, when it was 5 billion order of magnitude, and you say it is order of magnitude 50 billion plus today, yeah, it has obviously grown hugely over that period. And I think that part of it, and you're probably starting to see this a bit, is that you're seeing commodity specific royalty and streaming companies coming out. And so you might see some electric vehicle royalty and streaming, you might see some base metals, you might see uranium royalty and streaming company, all of these where they're trying to offer investors a specific vehicle for a specific thesis, whether that's precious metals to protect against inflation, or whether it's battery metals for perceived car revolution. All of those are different aspects. So I think that's really interesting. I think aside from that, I think within the streaming model where you're writing new agreements, you can already there's a lot of room in there to be quite creative on the terms and how you structure them. So I suspect that will continue to happen. I think that will probably be the main innovation within the royalty and streaming space over the coming years. And the next question, what advantages does Elemental bring to the companies worked with? And what, if any, things could go wrong and diminish the share price in the future? So I think that the key advantages that we bring to the companies we work with, number one, are it's actually very good marketing and visibility for them. I always think that if you are an operating company and you have a private royalty owner, they might sit in the background for 10 years and just own that royalty. But if you have that royalty and it's a material asset within, for example, Elemental, the great news is that we're going to go and, in the course of marketing Elemental, we're indirectly, of course, marketing your project. And so I think at Denver Gold, if it was last year or the year before when we attended, I think we were one or two companies after Premier Gold, for example. And so we were talking about their Mercedes Gold project just after they had presented on the company. So I think it's good from that perspective for them to get that increased profile from it. And I think in terms of the second half of your question, what if any things could go wrong and diminish the share price in the future? I think the two major aspects which we typically point to is always gold price. So we're directly linked to the gold price. Typically, net smelter or gross revenue royalty means that if the gold price moves plus or minus 10%, that is to a certain extent how much our revenue increases or decreases. So commodity price is number one, and number two is individual asset-specific failures. So if there was a mine that shut down or prolonged sort of issues at one of our existing royalties, that would probably be the two issues that would have the potential to have the most negative impact on the Elemental share price in the future, I think. And the next question is what is your view on the potential for consolidation in the royalty space? This is a question that's, I think, increasingly over the last 6 months been a topic. And I think probably particularly in the sub-billion-dollar royalty space, where there have been a number of new companies created or formed in the last 6 to 9 months. And I think it's interesting to look back sort of 10 years when there were maybe 10 royalty companies at that point that no longer exist today. And that's because they were acquired by Royal Gold, Sandstorm, Franco, Wheaton. All of those made acquisitions of smaller royalty companies. So it's definitely possible that that you'll see that again in the current space, and with the business model where it is very easy to incorporate other royalties into a company. I think it's you're not increasing your cost base particularly by doing it. I think that can make a lot of sense for the right opportunities, and I suspect over the coming 2 or 3 years, there may well be examples of that in the royalty space. The next question is, how tough is it currently to get good royalty deals? So this is a question as well that that we have answered over the last I think over the last 3 or 4 months quite often, and I think it comes down to two aspects. And it's the first aspect is who you're buying the royalty from. I think there is a difference to if you're buying it from a company or from a private owner, a third party owner. If you're buying it from a company, it might typically be as an alternative to that company raising money in the market. And so I think the terms will very much depend on market conditions. And I think when the market conditions are not as conducive to mining companies raising equity, I think that is when you're more likely to get good deals on the royalty front with operators. And then I think with private owners, I think often it comes down to gold price outlook, and there are opportunities there to, I think, acquire more, royalties there in less competitive environments. And I think that Elemental to date, of the sort of royalty deals that we have done, we've probably done about half of them directly with the counterparties, sort of in a one-on-one process, and that has been with some pretty big companies, the likes of Acacia, Barrick's African subsidiary, Yamana Gold, Carlton Breweries, Foster's Beer. So we've actually done we've dealt with quite a few very large counterparties where we have been able just to close a deal directly with them. And we have also, in 1 or 2 cases, the most recent one, South 32 as an example, we have been in a competitive process, but I think for royalties where we have seen the opportunity to put Elemental in a completely different position to where it was before. So the answer is it's always a challenge. The hardest thing about the royalty space is finding those really good opportunities, and I think that partly comes down to the asset relative to the company and where it sits. The next question is, will Elemental be an acquirer? And I think this is in relation to consolidation in the royalty space. And I think our view has always been that we focus on, if we focus on ourselves and doing the best job we can of building out the portfolio and of adding value, then I think as we go, those questions will always answer themselves. So I think it's not something we think about too much right now. I think for now we're thinking about a few royalty opportunities specifically that we're looking at, and then as time goes by, if that presents itself, we'll look at it at the time. The next question, thank you, is what other opportunities are there for investors to participate in the company? At some point, will there be dividends paid to shareholders? So it's a very topical question, actually, because as a private company prior to our listing, we did pay a dividend. And we actually paid a dividend as a private company from day one, and we linked it to royalty revenue. So we paid 5% of royalty revenue as a dividend to shareholders. And when we did that, we actually found that every shareholder, I think bar one, took those dividends in more shares in Elemental. And so effectively, if you have 50 shareholders and they all get a sort of pro rata dividend and they all take it in shares, you effectively end up in the same position you did before. And so I think that our view when listing was that we did sound out a number of institutions and shareholders and investors on it. And I think the consensus was scale up the company a bit more. So when we were private, we were very, very lean, very small team. And I think when you're listed, you incur certain costs as a listed entity that you don't have when you're private. And so I think the view was, get the company up, add some more critical mass and scale. And then I think we're in a position to start to think about a dividend going forwards. And I think that's one of the big benefits on focusing on producing royalties, is that it gives us that revenue and diversification that once Karlawinda is on stream and we have the benefit of it, running at full production going forwards, I think these types of questions, dividends, I think some of those become, real possibilities to consider. So we never tie our hands at this stage, and we've only been listed for 4 months, but I'd say that it's definitely something that's always been on the radar. We did it as a private company, and I think if we find ourselves in a position where we can sensibly implement a dividend policy going forwards, I think that would be an attractive option as well. I think, another question, thank you. What is your view on refinancing, renegotiating the Sprott lending facility to a lower interest rate? Okay, so this question is in regard to the $25 million US loan that we took from Sprott Lending in conjunction with this acquisition. And it has a minimum 6-month term on it, and it runs for up to 2 years. And I think our view is that I think if you look at 1 or 2 of our peers that have done similar acquisitions, I think you'll see that they were able to refinance their lending facilities subsequent to those transactions and get a materially better interest rates and terms. And I think that for us going forwards at some point, the opportunity to have a credit facility at say 5% instead of 10%, I think that's definitely a possibility that this acquisition opens up. And I think that when you look forwards, one of the things you want for a sort of permanent credit facility is some size and scale, and I think that that's something that enables us to do it. And so I think we're really grateful for Sprott Lending to date, because they have been remarkably efficient, quick, and flexible, and that's enabled a company like ours to do what will be now $67 million US worth of deals this year. So the one at the start of the year on Trangas Wagnon, and now this portfolio acquisition. I think deals that are sort of the size of the company, I think that's enabled by having those flexible debt facilities. But I definitely think that as we grow, we can put in place a credit facility to replace it at better rates. And as a follow-up question on that, which is your strategy to refinance or to raise equity to pay off the debt? I think it's probably a bit of both. So we will come out of this financing with order of magnitude sort of $7.5 million US in cash. And so I think that it puts us in a position where, yes, we can still complete 1 or 2 acquisitions if we want, but also, if we do have the potential to refinance this next year, then it puts us in the position where we could put in place a facility that is effectively half the cost. And at that stage, we might be in a much better position if we were to raise equity to pay some of it off with Carla Winder on stream and with a longer term, lower cost facility already in place. So I think that might be the optimal way to approach it. I think those are the last 2 questions. So with that, and we're coming up for 45 minutes. So thank you very much. I think we'll bring it to an end there. Thank you everyone very much for attending and for all the questions. And if there's anything else that you would like to add, please get in touch with us directly. And we're always available on phone or mobile, time zones notwithstanding. And it's actually, from our side, we genuinely enjoy hearing from shareholders sometimes. I don't think we hear enough. So please do reach out. And otherwise, if we don't speak to you before, have a very good Christmas, New Year, and we look forward to touching base with everyone in the start of 2021. Thank you very much.